Nick says, "Hey, Austin and Robert, I love the podcast. I'm a longtime listener, and I've shared your channel with my family and friends. Right now, I have $100,000 in various funds, mostly technology, NVIDIA, SPYI, VGT, stuff like that. My 401k is roughly $140,000 in various funds selected by myself and my company. My mortgage every month is about $3,600. The condo is worth $450, and the remaining balance is about $295. And my monthly spend on everything beyond my mortgage is about $4,000 per month. This includes food, going out, miscellaneous, things like that. My income ranges between $7,000 and $10,000 per month after taxes. My budget is very tight, and I don't have much left over to contribute and invest. What should I do?" Robert, what a precarious situation Nick E. has found himself in. Why don't we offer him some advice? I'll let you go first.
Nick falls into two categories: living beyond his means and not understanding that you either have an income problem or you have a spending problem or both. So let's break it down. So Nick, right now, you are the prototypical U.S. household that makes good money and spends all of it. So you put yourself in a very, very difficult situation because your house alone, your all-in house payment is over 50% of your net income monthly. And that is a recipe for being broke for decades. And you're not alone because so many people do it. I would guess over 60% of U.S. households do this exact same thing. So from there, you need to figure out either how do I make more money or how do I lower my expenses? In my opinion, I'd probably sell the condo as soon as possible, get that equity. I would roll over into a less expensive property, maybe do a 1031 exchange to offset some of your tax burden. And I would get that down as much as possible because at $3,600 a month, that's just your household burden. That is so high for what you make monthly that you have to make a change either with a lot more money per month or with less expenses. So that's where I'd start.
100% agree, Robert. So I just jumped into Bankrate's website. They got a mortgage calculator over here. And what I did was I took the median home price, which I think is $438,000 as of April 2024. And I assume that that's the home price you're going to go, sell a condo and then take this money and go buy with. You put all $135-ish thousand as you roll it into that property, like you said, Robert, 1031 exchange. So now what you're doing is you're borrowing the difference of about $300,000. Now the kicker here with the condo that's eating you alive, in my opinion, is the HOA.
Yep.
In your email, you mentioned the HOA is $780 a month. So it's a ton, right? That's a lot of money. It makes sense. Condos have that. You got your perks, the amenities, things like that. Let's go find a single family home in a normal neighborhood that doesn't have a high HOA. And I did the mortgage calculator here for you. You're looking at about $2,200 a month if you do something a little bit different, right? You go find something in that same 435 range, you 1031 exchange the equity into the next property, and now you've just unlocked $1,400 a month of saving, investing, but more importantly, margin in your budget, right? The first way you can tactically solve the problem is there's not enough money for the rest of the month is to get rid of the condo, take it, 1031 exchange. Now you've got a monthly payment of about $2,200 versus $3,600. That's now $1,400 more per month that you can begin to save and invest. The second way is better understand with the difference between the $7,000 per month and $10,000 per month. Is that overtime? Is that a sales bonus? Whatever that might be. And depending on what type of job you have, I want you to beef up that emergency fund closer to 5 or 6 months of expenses, considering this difference of $3,000 a month that you could take home or not take home. So I guess I'm trying to get at here, Robert, to your point is begin to pull down the housing from $3,600 to about $2,200 by selling the condo, 1031 exchanging it to something else. And then 2, beef up the emergency fund. Let's call it $10,000 to $15,000 over the next, call it 12 or 18 months. So that if you do have a couple months where you're closer to the 7,000 take home versus the 10,000 take home, you've got some wiggle room here with your emergency fund to help you bridge the gap so you don't find yourself going into credit card debt or worse, selling your investments to offset your daily lifestyle.
And for anyone listening, the easiest way to do this, like in this instance, let's say the blended average is $8,000 a month. there was a 7 to 10,000 range. The easiest way to do this is go, okay, if I want to save a minimum of 15% of my net income monthly at $8,000, I need to be saving and investing $1,200 per month. If you're not doing that, and you're either much lower or, like he stated, you are living paycheck to paycheck, you're doing it all wrong because you can't kick the can down the road forever. We say it every day. That is the easiest calculation. Look at the last year and say, how much have I put away for the future? And if it's not 15% of your net, then you're living beyond your means.
And in this instance, his beyond his means is the house, right?
Yeah.
His house brick.
Yep.
He is literally 51% of his monthly take-home pay, assuming that $7,000 range, is going to his house,
Yeah.
which means you've got a problem. This is an emergency. Let's get rid of the house. Let's use some equity to go find something else. And if you can bring that payment down from what you alluded to, from this $3,600 to $2,200 that I shared, that $1,400 a month is the $1,200 a month that Robert was just alluding to, right?
Yep.
So that's where you find the money to save and invest up to that 15%. I promise you, Nick, you've got a good situation. You just have to kind of look at it from a different angle, get the condo sold, and get after it.